Hello, I am Lisa J. Stocks here with a pop-up live tonight, and I'm going to be talking about the recent share splits when it comes to Vanguard and a few other topics. Let's see. All right, so if you're just coming in, as you come in, make sure to give the live a thumbs up. Let me take a look at the comments tab. Let me see. All right. Okay, so over here, we talk all things money related, especially the stock market. And we recently had some share splits, and I wanted to do a follow-up and just chat a little bit about what has occurred. So when it comes to VGT, for example, it has dropped from $800 down to around $104, as you can see right here on my screen. But there's nothing to panic about. This is a good thing, nothing to worry about. They had an 8-for-1 stock split. So just a few weeks ago, for example, back on March 30th, it would have been about $700 per share, but now it's $100 a share. And going by today's price, we can easily tell 8 times this 104, it would be over $800 per share if it was at that post-split price. So you guys love these type of things when our shares become more affordable, more accessible, even if it's just that psychological boost of being able to buy more shares. Most of the time, there is enthusiasm and investors love this. And so it's part of the reason why these funds do this from time to time. Let me take a quick look over to the comments tab. Hello, Daryl. Hello, Thrive and Glow with Joe. Thank you for tuning in. All right, so before the split, obviously, we needed hundreds of dollars to buy the funds that we're going to be talking about tonight. So here is a breakdown of all of the funds that recently had the split. VGT was the largest, the one that we started off looking at, and that was an 8-for-1. But we also have VGT and VOOG 6-for-1 split, VO at a 4-for-1 split, and MGK a 5-for-1 split. So all of these are in effect now for the last few days. And so I wanted to touch on this. And I know I had quite a few comments. So someone put in my comments and it got quite a few reactions, but I'm sure more than one person mentions on my initial video about this that they were disappointed that VOO was not one of the funds, but we're going to get into why that is. All right, so what exactly is a split? As I was talking about earlier when we were looking, okay. So a split is just pretty much exactly what it sounds like. They're making it into more pieces. So instead of a $20 bill, you're getting 4 $5 bills. Think of it like that. It's simply the same amount, just split up differently, more accessible. And thank you for that, Joe. So I gave the breakdown of how these splits are broken down. And let's see. Let's take a look at the returns of these different funds so that you can get an idea of why it is perhaps that VOO, which is one of the most notable Vanguard funds, I would say. It tracks the S&P 500. It's currently $657 a share. We have hit, I think, 10 all-time highs when it comes to the S&P 500 this year. So, and Vanguard does happen to have a higher price ETF when it comes to being able to invest into the S&P 500. But it's not the factors that you may think would have led it to being a part of the split are different than how they go about doing these things. So I have all of the funds that underwent the split recently, those 5 funds, as well as VOO on this chart. And this is on the 10-year to see the growth that it's had over the last decade when it comes to these funds. I'm going back and forth to the comments. A brother of a certain age, thank you for tuning in. Thank you guys, my channel members. Feel free to drop your membership milestone and let me know if you guys have any questions. All right, so I'm going to go back to my notes here. All right, so taking a look at what I pulled up here. Over the last decade, VGT, the fund that had the 8-for-1 split, has had the strongest growth. It's up nearly 750% on the 10-year. Very impressive growth when it comes to this fund. It's a technology-focused fund, but MGK, let's run down what these are here. MGK is the Vanguard Mega Cap Growth ETF, and then VGT is the Vanguard Information Tech ETF. VUG is the Vanguard Growth ETF. VU is the Vanguard Mid Cap ETF. And then VOOG is the S&P 500 Growth ETF. And that one, I think, is on the lower end when it comes to performance. But let's pull this back up again. All right. So as of today, the 27th, we can see 10-year performance on these funds. VGT, that had the largest split, has the largest growth. And next up is MGK, and that one is up about 435%. VUG is up about 399%. VOOG right behind at 389%. And then VOO, which did not get that split, the S&P 500 fund, is up about 302%. And then VO is down the least at 192%. So looking at this, we can see that a few of these funds, the ones here at the top of the list, have had significant growth, and their share prices were also getting up into the hundreds. But we see that VOO has had stronger growth than VO that received that was included in this recent share split. So I just want to touch on why that is. It's not these are not the factors that they go about. I know we wish they did, because I know from the comments and the reactions, like I said, and on my last video, people want to see VOO under, at a lower share price. But it doesn't matter. It doesn't matter. I never let the share price hold me back. But just to touch on why, I did a little research to see why I think that VO was included while VOO was not. And I'm only mentioning VO specifically because it's the one on the list that actually has lower performance growth over the last decade than VOO. And from what I see, it's because VOO is able to continue to trade easily and very significantly. VOO trades 5 to 10 million shares in the same time frame that VO trades about 2 to 3 million shares. So even though it's trading less, even though VOO is has that higher price, that stronger growth, it still has that liquidity. It's able to trade very easily, and it's still a very strong performer. So it seems like that is one of the biggest factors that probably caused it to be able to remain out of any share splits. But any of these funds are affordable choices that have pretty low expense ratios, and you can incorporate them in order to build towards your goals. So let me take a look back to the comments. Make sure you guys hit the like as you come in, and let me know if you have any questions. So, like I was saying, it is a psychological boost to be able to see your share prices growing. I know I've never let a share price hold me back from investing, especially when there were significantly higher price things that I wanted to get going with incorporating into my portfolio. I just didn't worry about the share price, didn't worry about how long it was going to take me to get to a full share. I just focused on putting whatever dollar amount that I had available in my budget in order to invest. So I did that not even knowing when or if there would ever be a share split when it came to my investments. And in time, it did happen to me several times with Tesla and Google and a few of my other investments, even most recently Netflix. Okay, so now let's take a look at, as I said, the S&P 500. I think already we've had 10 all-time highs in 2026. And so we've had several recently, because as we can see here, this chart is right now on year to date. We bottomed out pretty much on March 30th, but now we see that we're trending higher than we were even at the beginning of the year. And so this is why we have to have an understanding of what we're invested into. Investing into the S&P 500 is one of the easiest beginner-friendly investments that you can have. It's just a matter of finding one that has a low expense ratio, but when it comes to this one, there are several. And so it's something that I think that if someone wanted to get started with investing today, they had, really no knowledge, I would tell them you do not have to wait. You can get started with this and then figure everything else out after. That's how easy and beginner friendly and a fit for everyone's portfolio I feel that this is. Maybe not if you're like 75 years old, already in the retirement, stage of life, but if you are, anywhere in the building phase, I think it's a great fit. So let me go back to the comments and we'll take a look at some of the funds that today are really helping the S&P to thrive. But as we saw, things have really turned around, even though, things are not settled when it comes to the war, and the market swings have been drastic in general under this administration. We are a whole year into past when he announced those tariffs last April. So we've seen what this is. We have more years of it. So we have to get ready. We have to be ready to endure this for a significant more time, but it is what it is. And so, like I always say, I have to have to trade, invest, and stay on track no matter what the current administration, what the stock market is giving me. I'm going to work with it. So if it's down, I'm going to focus on doing my research, having an understanding, so I can invest into things that I feel confident in the recovery of. And so something like this, 500 of the strongest companies in the US, something that's going to rebalance for me, they're going to kick out anyone who's lagging, who's, not thriving, giving the highest weighting to the largest companies like Apple and Microsoft and NVDA, of course, a $4 trillion company. Those ones are going to be leaders when it comes to these funds. So on the day, I was just looking at an article, and these are a few of the names. Well, I have this on the 5-day right now, but you can see whether I put this down lower to today's date or over the last 5 days, we see that these are a few of the companies that have helped the S&P 500 to be thriving. And it's ScanDisk up 14% over the last 5 days. We have Micron Technology up about 16%, NVIDIA up 7%, and Intel is up 26.44%. So out of these 4 individual companies, the only one that I hold a direct investment into is NVIDIA. So I don't have to pick all of these individual stocks. It would be unmanageable, and I would not be able to build up a significant position into anything if I couldn't narrow it down and decide where I'm going to get my exposure through my funds, and then what are going to be my select blue chip stocks that I'm going to incorporate in order for that additional growth. When I do my videos, I share, and I have had more significant gains on my individual stocks as opposed to my funds. But those funds give me diversification. They give me simplicity. They don't have those huge swings that some of these individual stocks can have. But I'm in a place right now where I am leaning towards quality. So especially if it's an investment, I have to have a clear mindset when something comes into my portfolio. Is this a trade or is this an investment? Because I am in this to make money. My goal is to make money over here. And there are certain investments that have more volatility, that have not proven themselves. And so I have to make sure that they remain under trade status when it comes to my portfolio in order to mitigate my risk and make sure that I'm on track to achieve my goals. So hello, Jessica and everyone that's tuned in. Guys, let me know if you have any questions, if there's any funds or individual stocks that you might want to take a quick look at. I just wanted to pop on today and give just a quick little update on what the funds that recently underwent a stock split are looking like when it comes to those Vanguard funds. So we can take a look at all of them. So we'll put them on year to date. So just like, let's put all of them on the same chart so we can see how everything is comparing. And guys, just because I mention a fund, it does not necessarily, I try to be clear in my videos, but just because I mention an investment, make sure that you are doing your research, that you are taking the time to have an understanding of my views. If you're interested in understanding what I'm trying to explain, because just because it's something mentioned in my live stream or a video, doesn't mean that everything is something that I would hold. So have your ears open, have an understanding of what I'm touching on. Someone on Twitter recently said that they invested into MGK after discovering it in a video that I had shared. So not something that I hold, but low expense ratio, I think a good stock for growth, something to pair with something with less volatility. So I see your question about SCHD. I'm just gonna put up these funds so we can just take a look at how everything is looking post-split, and then I will talk about that. So we have, who are we missing? I think my, VOOG. Let's see. Is that who we're missing? Yes. Okay. So these are the 5 funds that recently underwent the stock split. For those of you who weren't here earlier, here they are listed out. They had, different amounts as far as how the splits went, from 8 to 1 down to 4 for 1. But these are the different funds. And so this is a look at all of them. Over year to date, VGT is up the most significantly. It's up 10.72%. But like I said, your personal preference on how you want to go about building your portfolio. But I like to have some amount of stability, something that I know, I'm just going to get those steady dividends. I don't have to, I know it's going to recover. And so right now, I do have a willingness to invest into things like SMH, which is a semiconductor ETF, but I feel that that is an area that is going to thrive. And by not having to invest into all of those different companies individually, I'm able to still capture that growth. Now, we see different things like Intel, but you have to realize, don't ever beat yourself up about these things like you missed it, because did you really miss it? You have to be able to navigate things as a trade versus an investment sometimes in order to capture those gains. And so I don't worry that I missed out on certain things, because I know I'm investing. I know what I'm investing into is growing. And I know I put the work into knowing what I'm incorporating. So that's why I've learned from my mentors to know, and I've learned from my own personal experience of, like I touched on yesterday in my live stream, I think I used the example of ChargePoint. Something can just go down to basically zero. And you never know. It could be a well-known, a household name can still have struggles. So you never know. And you have to be on top of things. I invested into Target. Let's take a look at, this is Target over the last 5 years, down 37.41%. Years ago, I would not have thought that Target, a household name, a place I go to all the time, where if you need something on the go, where are you running? Walmart, Target, right? If you don't necessarily just, get on your app and order from Amazon. So I just did not know that they would just be year after year having these issues. So you have to be ready to adjust when it comes to these things in your portfolio. And hey, David, I see you're tuning in. You have VUG. I do not have VUG. I would say what I'm holding in my portfolio, as I've been mentioning, that I feel is the most similar. My growth fund is FSPGX, and it is an index fund that I'm investing into over at Fidelity. I recently shared an update. I just got to 100 shares on that, and it's a low price fund. It's only in the $40. And let me put that up here with VUG so we can, I usually use the other chart for this, but let's go to year to date. So my growth fund versus VUG. VUG is up 2.68%, while the fund that I'm invested into is up 1.4. VUG now after the split is $83, and the fund that I'm investing into is currently up to $46 per share. So let's get rid of this and put SCHD on the chart. Now this one, let me actually put it in over here. So SCHD year to date, up 13.49%. So this is the Schwab US Dividend Equity ETF. And don't forget to like and subscribe. Thank you. Thank you, Jessica. Guys, Jessica is reminding you, did you hit the like when you came in? Are you chatting? Are you going to leave me a comment after the live stream? Refresh. Why am I getting this message? Continue. SCHD. All right, so SCHD top holdings, we have Texas Instruments, United Healthcare, we have Qualcomm, Chevron, Coca-Cola, Pepsi, Procter & Gamble, Home Depot. I didn't name all 10, but these are much different companies than we see in our other funds, and we're going to see in our growth funds or our S&P 500 funds. Those are going to be led by those same names: Apple, NVIDIA, Microsoft, Meta, those type of things, the Mag 7. And so this is a different mix, a different sector mix, more heavily into staples, healthcare, energy before we get down to technology. So it is a dividend-focused investment. Now, let's see, Jessica or anyone else that is tuning in right now, I have kind of shifted when it comes to dividend-focused investments in my portfolio. I do have SCHD, so smaller positions when it comes to these. I have SCHD, I have Main Street Capital, I have some SPHD, and I have Realty Income, if I didn't say that already. So those are some funds, and BDC, REITs. Those are some investments that I've incorporated into my portfolio for the dividends, just like SCHD. But I've decided that for now, I'm going to hold on to what I have in those positions and focus more on growth, and then a little bit later on down the road, shift more of my portfolio into those dividend paying investments, because it's not like I'm in the place right now where I want to live off of the dividends, where I want that income. And so I've decided to focus on growth. Then when I'm more in that preservation stage, shift over to it. So Jessica, my thoughts on SCHD, I think that it can be a good fit for your portfolio depending on your goals and needs. It is a quality investment. It does pay a stronger dividend. It definitely is going to give you diversification because it gives you exposure to a heavier weighting into different companies than you're going to get that from your growth funds and your broad market, like a total US stock market or S&P 500 investment. Let me go to the chat and see if anybody's saying anything. Okay, True. I see what you're saying. Yes. So I don't know your age. I don't know your goals. I don't know if you're focused on early retirement, striving for FIRE. It can be the perfect fit for the right person. Someone recently asked me about SCHD and SCHG, which, let me see, can I Guys, this is the ETF RC. This is ETF Research Center, and you can get to it at etfrc.com. And I like it for certain little quick lookups. So you probably, if you watch my videos, you might see it from time to time. SCHD versus SCHG. And I think I touched on this yesterday, actually. So we have 0% overlap between these two funds. So very different. The person asked me my opinion of these two funds, and I was like, yeah, this is drastically different. This is high growth, and this is, more conservative, steady dividend focus. So I told them, I don't like I just said with Jessica, I don't know what you're striving for. What are your goals? What are your needs? What stage of life are you in? If you can have both. I have a growth fund, and I have some SCHD in my portfolio. But the thing is, you have to decide what balance you want. Are you more of, oh, I put the wrong thing in here. SCHD. Okay. I had put SPHD instead of SCHD. I corrected it. Now we have a 1% overlap. So no significant thing there. But okay, so we have the Schwab US Dividend Equity ETF versus the Schwab US Large Cap Growth ETF. So if you're going to have these two things in your portfolio, you have to think, what are my goals? Do I want to focus more on getting those dividends coming in, or do I want to focus more on growth, getting that share appreciation, even if it is going to be at a significantly lower dividend yield? So, and then, maybe you capture the growth for now and then shift back into SCHD. So depending on what your goals and needs are, you have to think about which one is going to be the 80% weighting and which one would be the 20% weighting, because each of us have to find that fit for ourselves. Okay. My investments are certainly guided towards stability. Index funds, CDs, high yield savings. Don't like thinking about it too much. Haha. Okay, thank you for sharing. Yes, I think I'm the same. I have all those things going on. Index funds. I try not to keep too much money in cash, but at the same time, I have to have some cash on hand. And I have some money in a CD right now. Of course, I have my high yield savings account. And I think that's important because I do not want to be in a place, I don't want to have to sell my investments in order to pay my credit card bill or deal with a broken furnace or something like that. So I try to just work to have a balance where I feel secure. If I do have to use my credit card and have to go heavily into my savings, then I just take that time to replenish it. But as long as I can find a way to, handle it myself, I don't want to have to take out I don't want to have anything lingering on my credit cards. I don't want to have to take out a loan. I don't want anything that's going to make me have to incur any interest. And so that's how I go about it. But hey, Tim, thank you for tuning in. Yes, you have to be able to adjust to the market. I'm not sure what I was saying at that time, David, but definitely. I haven't, it wasn't thrilling looking at my portfolio between January and last month, but I continued investing. I continued setting limit orders. I felt confident in the positions that I was building up, and so I kept going. And now I'm definitely seeing my portfolios at the highest that they've ever been. Certain positions that were in the red, or I had very insignificant gains on. I'm now seeing them turn around, and so I'm not ever going to be in the place again. If you guys have been here before, you probably heard me mention about my story with Apple stock. I took a long break from investing into my Apple stock. I had about $120 average on Apple, and yeah, I had a mentality of I didn't want to mess up my average. If any of you are struggling with that, put the investment in a different portfolio. Do whatever you have to do, but don't let time pass and opportunity pass. Don't try to chase whatever you think is going to be the new hot, the next NVIDIA. That's not what I'm trying to do. I can invest into the actual NVIDIA, the actual, I think I did a video about this too, giving investments, giving ETFs that are heavily weighted into those companies that you might want to have that, a higher level of exposure to, like Microsoft and NVIDIA. But, if you're a person that doesn't want to have to buy individual stocks, by incorporating those funds, doing your research on them, knowing which ones are going to have that strong performance, have a long history that you can reflect back on, like the funds we were looking at earlier. All of them, we were able to see a 10-year history on them, I believe. Let me go back to that for a second. 1 year, 10 year. So yes, all 6 of the funds that we were looking at, we had VOO on here also, have a 10-year history for us to reflect on. And so, think I'm over here looking at the chart and thinking I'm sharing it, but think long term. Don't be discouraged if you are a little, feel like you're behind and didn't know about this when you were in your 20s or even in your 30s, but you can from your starting point of today, and just something is better than nothing. So don't be held back. Okay. Your Intel skyrocketed. Yes, we did look at Intel just a minute ago. I'm not sure if you were already here. But yes, that is one that has helped to push up the S&P 500. And let me take a quick look and see. Okay, I put my SMH here, and Intel is 6.1% in that fund. And that is the one that we were just touching on. Let me see. Put it over here. Let's see about SP. See what some of the top funds are in SPMO. No, we have Oracle. We have Oracle, NVIDIA, and Broadcom over there with some heavier weightings. But yeah, so you can easily have an understanding of what's pushing up the market, what's pushing up our funds. And these funds, they do the work for you. You don't have to keep on. It's great to have that direct exposure, but Intel was not moving for many years. It was kind of a sleeper. So these are the type of things I'm saying you have to, if you know how to navigate it, which I know Tim is a trader, he options trades, maybe he swing trades also. But yeah, it's been kind of a stagnant kind of investment that finally woke up after a long time. So it's basically back to where it was so many years ago. This is back in 2000. So I've had investments like this. I've had things in my portfolio before years ago. I would say like 6 years back, that I didn't know how to navigate as a trade. And so when it was up at the top, I can't think of the company. It's a pharmaceutical company. It went from $1 to $4. And I did capture some gains on it, but I didn't sell. Wasn't trailing up my stop loss. Say when it got to $4, I didn't have my stop loss at 360 and then 370, 380, in order to make sure that I captured those gains before it tanked down again. So you have to decide for yourself, what is an investment and what is a trade? So I like to highlight these things as different examples. Intel, definitely thriving right now. A leader in one of the funds that I'm currently investing into. This is SMH. We see Intel is the fourth heaviest weighting here, but it may cool off again. But you have to decide how long you're going to hold things for. If you're willing to have that stop loss on and potentially get kicked out of something before a year time frame and take on that heavier tax implication, you have to do what's right for you. I do a little bit of it all, but I just want you to be aware, and I want us to be in this. I want us to make money, and I don't want you to run into different situations that that turn you off to investing because you get burned and something doesn't go your way. I want us to have so much more of our portfolios and things that are thriving or always recovering for us, paying those steady dividends, that you can understand the fluctuations, tie them to the news. And so more stability, so that when you start to dabble, if you decide to, into things that are more volatile, you can navigate them. If there are some losses or there are something that drops significantly on you and is not recovering for a long time, like Target, which I mentioned already today, then you're able to work with it and you're basically not really feeling it in your portfolio. When I hear people say like their portfolios like all cooked up, a disaster. I was on someone's live this weekend, and the person, usually, even if it's, something totally unrelated to money, when I come in the chat and say hello, it turns into a quick little money discussion because the person on the panel may want to give me an update on what's going on in their portfolio. So one of the people on the panel was saying that their portfolio is thriving and everything is up. And I was like, yeah, agreeing with them through the chat. And someone else was saying that their portfolio wasn't doing anything. Their XRP and the things that they were mentioning are not moving in the way that these mega cap stocks are moving. They're mentioning smaller cryptos that are not capturing the gains of AI and the different things that we're talking about here. Not, incorporating energy and different things that we've seen be able to thrive because of the current economic and geopolitical tensions that we are currently facing. So Tim is shared where he was buying at between $18 and $45. So yes, for it to be at 85, we can tell where his average is and the percentage gain. But yeah, I just want you to look into the detail. And just using this as an example, as I mentioned, I know that Tim knows how to option trade, probably knows how to swing trade. is a person that is knowledgeable and wouldn't be stuck diamond handing. So my message is to people that may not have that experience. Don't just hear a company is thriving right now. Have an understanding of their long-term picture so that you don't buy at the top, they drop back down, and you're discouraged by your experience. Okay. So guys, thanks for chatting. Thanks for Abigail. Thank you for tuning in. Thank you for chatting. Let me see. I saw a comment from Noelle. Is this a pop-up show? I didn't know about today's show. Yes, it is a pop-up. I think I planned it 10 or 15 minutes beforehand. I wasn't in the mood for doing all of the editing and stuff tonight, but I want to start it. I really want to have content out every day. And so this is my way of being able to give myself my check for getting something accomplished today, other than a short. So guys, let me know if there's any other funds or individual stocks you want me to take a quick look at while we are live. Do you have different strategies for retirement accounts versus regular brokerage accounts? Small position size. Oh, your Intel is a small position size, Tim? Okay, so I'm gonna talk on this question, and thank you for asking the question. I do have different strategies for retirement versus my general brokerage account. I would say with my general brokerage, I'm willing to, I want my retirement accounts to be more set it and forget it. I am a very hands-on person. I do look at my portfolio and I look at all the accounts pretty much multiple times per day. I'm not even going to, beat around the bush and pretend like I don't. So I would say with my retirement accounts, I try to stick to more cost funds. I do have one target date fund in there. I would say I have less than 5 individual stocks in my retirement accounts. And just to name a few, Taiwan Semi, NVDA, and I can't remember what else. Taiwan Semi, NVIDIA. Maybe those are the only 2. There is one more, another company stock that I worked at, but like I said, it's less than 5. So I like to have those low-cost funds in my retirement accounts. Now, when it comes to my taxable accounts, I have built out positions for stability. I did do over 3 years of a stretch of buying $10 daily into VTI, for example. So I have my VTI and I have my VOO. I have a little bit of SCHD and, just a few funds there, but I am willing to capture more of the growth of investing directly into individual stocks when it comes to my taxable brokerage accounts. So that's where I have a position in all of the Mag 7, as well as, some other large cap companies like NVIDIA, AMD, things like that. So that's how I go about it. And then for my daughter, right now she's 80% funds and 20% individual stocks. Which she didn't want to choose her individual stocks, so I chose pretty much everything for her. But she has a bit of an understanding. I definitely want to get her more updated on it because we haven't been adding too much to it. I had some savings, some stimulus money from years ago, and that's what I used really to build up her UTMA account. So that's how I go about it. So yes, I do have drastically different strategies, much more heavily weighted in just long-term, set it and forget it. Stability funds over at Fidelity, as opposed to, for example, my portfolios on MooMoo and Webull are more aggressive and loaded with individual stocks, but I'm keeping up with the earnings and all of that. Okay. ASML, and do I have energy ETFs? I don't know of any offhand. So guys, I am heavily invested into tech or things that are very tech adjacent. Like, let's see. Do I have the, yes, I do. So when I say that, like Amazon or Tesla. Tesla is over here in auto manufacturers, and that's where it should be. But I feel like it is such a tech company with the robotics and the EVs and the self-driving technology and all of the advancements that Elon is striving for. So I lean into those type of things, semiconductors, technology, and I get whatever diversification I have through FXAIX, which tracks the S&P 500, for example. But I don't go really, I personally have not thought out having more of a heavier exposure into energy or healthcare. And we've seen with what we've gone through this year that there are going to be times when those other sectors are thriving, are beating tech. But overall, if you look over on a longer time frame, I'm thinking like that. Like I said, with my retirement accounts, I'm thinking long term, I'm thinking simplicity. And I think that I'm comfortable leaning more into tech than those other sectors that are going to be tied to certain shorter time frames as far as their strong growth. But we can definitely look up some. But I just would not have any to really share off the top of my head. Going back to Tim's question of, so ASML. Let me pull it up on my app. I know Nora asked something yesterday, and as soon as I looked at it on, I think I still have it here. Well, she was asking about this. She was asking about Rocket Labs yesterday. And some things are easier to understand than others. Like, okay, so I'm taking a look at ASML. Let's put that on here so we can all see what it's looking like. $14.32 year to date. All right, so I'm looking at a few facts on ASML. I see the PE is currently about in the high 40s, 47, 49, but the forward PE is lower. So they're anticipating improvement. The beta is 1.6. So a little bit more volatility. And I know that this is a, let's see, I'm over here. Let's see, is this? I was just taking a look to see if it was any in the top 10 of any of these funds, which I'm not seeing it. But let's take a look at the company itself. higher share price. It's rated as a strong buy, average price target of about 1,800, a high of 1,900. But yeah, taking a look at the PE and the forward PE, and they have been meeting their financial expectations. Let's go down. A little heavy on the liabilities here, but they are on track to have to grow to potentially a $10 billion revenue later on in 2026. They haven't been really beating expectations. They've kind of been in line, but it's one that seems to be on track. I think there are definitely stronger companies at a glance. Looking at a few different factors here, I would probably go with a company that had a bit stronger financials than this, or just stick to getting exposure to it through my funds. But that's just the place that I'm at right now. I want to be pretty selective in what I'm incorporating so that I have less worries about the long-term performance. So let's take a look at how So this is the balance sheet of ASML. And there are so many factors. I'm just touching on a few here, and I threw out a few numbers that I was looking at on my MooMoo investing app. Like I said, the forward PE is going down, so they are anticipated to be improving as a company. But looking at the balance sheet and looking at the liabilities versus the assets, that's the yellow is the liabilities. And then we switch over to AMD, we can see that their liabilities are significantly lower. So take some time and see if you really think that this is something, that is a good fit for you to have direct exposure to, as opposed to finding a company that is a little bit more mature and thriving. But it is anticipated to be on track for growth, and I'm not mad at, you know what? Another thing is, you take a look at how many analyst ratings there are in comparison to a larger company. Because now that I go back to it, the ratings that I gave are only based on 5 analysts. So many different things for you to weigh. But at a glance, I would say I think there are stronger investments that I personally would go with. Let me know your thoughts. So guys, I was responding to Noelle's question about a little bit of my thoughts on ASML. Yes. So Tim is sharing that ASML dominates in the semiconductor industry. But do you think that AMD, Taiwan Semi, there are other companies that are currently stronger? Or do you think that potentially ASML in time could outperform those? And each of them may have a slightly different aspect of the chips and the different things that they provide. So they could have a niche in there that have them become a bigger player in time. But this is when it comes down to really digging in, doing your research, and determining what's the best fit and what's the best way to have exposure in your portfolio. So I think I've gotten to the point where I was getting to the place where I wanted to start to limit my semiconductor investments. So that's when I decided to start building into SMH. So Taiwan Semi buys their tools from ASML. Okay. So yeah, they're going to be linked together in these ways. So Noelle, let me know what your thoughts are. I don't have everything that I said was not, not negative, not a total. There are definitely, it is definitely a company on track, like I said, to be a significantly higher market cap than where it is right now. So as Tim mentioned, there's an article right here from 2 days ago about Taiwan Semi and ASML. 117% in 1 year. Let's take a look at the year. And let's take a look at it on the 1 year. So on the 1 year, on this chart, I'm seeing about 113% growth. So yeah, very impressive, very impressive. Okay, so guys, let me know if you have anything else that you might want to take a look at. Thank you guys for tuning in and chatting. This was a pop-up tonight, and I might be doing more of them. I always tell you guys to have on your notification bell so that you can keep up with my videos and live streams. I will be live again on Friday this week for a lunchtime live with my YouTube associate co-host, Marlene Motivates. So I'm going to set that up so that you guys can go over there and hit that notification bell. If you're, busy during the day at work and things like that, come back and catch the replay. I do always try to go back to my live streams, add chapters and things like that, so you can navigate it if you come in late or just catching it on the replay. So Noelle is saying you have it inside of an ETF. Okay. But you're thinking about and having a direct investment also. Okay. Okay, I don't think I missed any questions or comments in the chat. I was saying something funny. Noelle was like, LOL. I'm buying CMG now. Okay, I'm not sure what that is. Is that Chipotle? Okay. All right. So guys, thank you guys for tuning in. Make sure to like, subscribe, hit that notification bell. And feel free to leave me any comments, questions, requests of things that you want to chat about in the future, in live streams, in my videos. And I try to be mindful and take a look at those things in order to bring to the community what they are looking for. So if you're not already, consider joining channel membership. That's a way you can support the channel. If you're interested in opening a new account, I have a referral link for the MooMoo Investing app. You'll get 8.1 APY on your uninvested cash for the first 3 months, and so many other benefits and research tools over there. Now, I've been building a portfolio. I've been using the platform for many years now. That's where I'm holding my Realty Income, SCHD, AMD, Microsoft. So I've been using it, very comfortable with it. But I also have portfolios for all of my retirement accounts, my daughter accounts, my business account. I use Fidelity for all of those. So I am also a Crown trader over in Keenan Grace's Discord. So there's a link for that in my description. If there is anyone interested in learning about options trading, being a part of a larger community with those different things that are available, but you have to put in the work to learn. Hello, hello. Thank you for tuning in. I think we're going to be wrapping it up unless you have a funds or stock that you want to talk about or take a look at. But welcome in. Consider subscribing to the channel if you're not already. Okay. Again, thank you to Thrive and Glow with the Joe for that super chat and for being a channel member. And be on the lookout, have that notification bell on so you can keep up with all of my videos, live streams, shorts. I do try to keep to my regular schedule, and that is 3 p.m. Eastern Standard Time every Sunday. So I will see you soon. Thanks for tuning in.
And to investments, she made a lot on YouTube. Lisa J Stocks. Lisa J Stocks, that's the channel. Hey. If you wanna make some money, visit Lisa J Stocks. Yeah, yeah. You'll make a lot. If you wanna make some money, visit Lisa J Stocks. Okay. She'll make it pop. If you wanna make some money, visit Lisa J Stocks. Yeah, yeah. Hey, you'll make a lot. If you wanna make some money, visit Lisa J Stocks.